Dr. Nirmal Bang, ladies and gentlemen, I'm here Aldadia. We have with us Mr. Aditya Sood, Portfolio Manager at InCred Multicap Portfolio, joining in. Welcome to the show, Aditya, and always a pleasure to speak to you and get insights from you as well. Clearly, Aditya, right now, if you go to see in terms of what's happening in the markets, we've seen highs of highs, and now there are these correction bouts that have started to come in. What is the overall picture according to you?
So, Hiral, thanks for having me. Thanks. Essentially, I think so. We are in a very, very interesting construct of the market. On one hand, we have got, things which have been never experienced by experienced fund managers. I have been investing for close to 2 decades now in the markets, but I've never seen, this kind of a construct ever in my career, in the sense that, 40-year high inflation in the West, prolonged war after 75 years in Europe, and it doesn't seem to be coming to an end, because initially when it all started, the inflation narrative was that inflation is transitory, and that was a narrative from the central banks of the world. And the war narrative was that it is equivalent to a surgical strike, so it will come to an end. Unfortunately, it hasn't, basically. So I think so. Markets are in a phase of readjustment to the new reality. And what we have seen is that, it has unraveled very, very quickly in the last 6 months. Obviously, the first half has been, very, very painstaking for investors who are invested into US equities. Obviously, it has happened after 13 years of US equities doing well. And now we are seeing, interestingly, quite a bit of divergence in terms of, emerging market performance. And specifically, our belief is that, India is going to stand out because, the global cycle is not clearly very constructive. And in many ways, India is not a decoupled emerging market, and, none of the emerging markets are decoupled in the true sense. But what we are witnessing is that, we are coming out of a very, very low base of earnings growth, very, very constructive geopolitical environment going forward. India is very, very different from what it was when crude was $100 in FY 11-12, basically, wherein the software industry was, small. Today, we are clearly moving from strength to strength, and obviously, the corporate earnings cycle is going to help us in many ways. So that is what we think at this point in time. Environment is looking, slightly more constructive post the correction.
Right. So with all of this, I assume, we are looking at the rising inflation, interest rate hikes, plus the way the commodity markets have moved in the recent past. All of this is something which is having an impact on the domestic markets as well, right? So do you think this kind of volatility that we're seeing right now is just a midterm, a stopgap kind of a phase, and we should see some bit of stability arising from here on?
Sure. So I think so. We are, as I mentioned, we are just trying to readjust. But let us take a, stock of situation. When I speak to my colleagues in the West, clearly they are very, very worried because, nobody has experienced 7-9% inflation in the West. They were living in an environment, wherein the inflation was like more trending like 2 to 3%. And that has happened over a prolonged period of time. So if you look at the inflation differential, so let's say if you were in US or UK and you were leading a normal life and having inflation 2-3%, it hurts you more, when you look at a 7-9% sort of a number. How many times in our lives we would have imagined that the Indian CPI is going to be lower than US CPI, and that is where we are today. Where we are at a 7% sort of a CPI number, wherein US is trending more like 9% at this point in time. And the similar things are getting reflected in mortgage rate differential between US and US and India at this point in time. Indian mortgage rates were as low as 6.5%. 3 months back. Now the mortgage rates are like 7.5%, but the US 30-year has trended at, close to 5% now. I think so. It is more about the differential. So these differentials have to be, minutely understood. Second thing is that, I've always believed that moderate inflation is good for equities as an asset class generally, because, it helps you to have higher top line growth. Possibly, some of the commodity companies benefit in an environment wherein you can export. But let us take a stock of, the commodities. What has happened essentially is that, post-COVID, the commodity prices, and I have lived through that 2004 to 7 cycle of commodities, which was absolutely a booming period. And nobody would have imagined that, we could have steel prices being higher than what they were in the 2004 to 7 boom. But what COVID did to us is that, steel obviously shot up from 40 rupees a kg to something like, 95 rupees a kg. Now, a lot of steel companies, obviously, they could themselves not understand that, that this kind of deleveraging will happen so fast. But it has happened. So our view going forward is that, we would be more constructive on commodity consumers versus commodity producers. The thing about, commodity cycles generally is that they just come and go. And, the next boom comes in 10 years, basically. So these are long cycles typically. The only distinction that one needs to draw now here is that, the cycles are getting shorter. Earlier, you used to have an environment wherein a boom cycle typically used to last for possibly 3-4 years, and that is the world that we were used to. And a bust cycle will typically last, for 18 to 24 months. Unfortunately, the world that we are living in, which is so correlated and intertwined, driven by central bank policies, that these boom bust cycles just play out. And I mean to say a bust cycle can play out in 6 to 12 months, as opposed to 18 to 24 months. So I think so we are witnessing that at this point in time, and hopefully the markets are going to price in the rate hikes. I think so already there is some sort of readjustment which has already happened. It has been digested well by the markets. So going forward, our view is that, one has to work with the realistic assumptions. Second point here is that, you have to always remember that in a world wherein you are so policy dependent, there is a lot of policy intervention from the governments, be it, we have seen it recently happening in oil and gas, we have seen it happening in steel, essentially. So we are in an environment wherein obviously the governments are going to be more worried about how inflation is going to impact political mandates going forward. And we are all obviously, witnessing what is happening in Sri Lanka. It is all in the papers at this point in time. Right. So I think so governments are taking cognizance of this fact that, they would politicians will, obviously hate to lose election because of, inflation. So there is going to be heavy intervention in sectors which are going to, disproportionately benefit. Basically, that is how we.
Right. So overall, if you see in terms of the valuations right now, how would you value Nifty as compared to other emerging markets?
Sure. So interestingly, I think so there is a fair bit of correlation to the premium that India has enjoyed in MSCI. So if you go back and you look at long history of India's premium, it is like close to, India has outperformed MSCI emerging markets by roughly 2.5% thereabouts over a 20-year period. Now, this has got to do with superior potential of India in terms of profitability. So the best performing emerging market from 2001 to 2007 was possibly Turkey. And Turkey used to have a profile which was very similar to India in the sense that, the demographics, earnings growth, we were having a very, very superior ROE country. And I was in London during those days. And, it used to be an emerging market which was favored by most of the people. So our view is that, India premium has got various factors that are supportive. The first factor obviously is, favorable demographics, but the thing is that, it takes a lot of time for that demographic profile to play out. A second factor obviously is the level of urbanization that we are in India today, and a similar sort of urbanization play has happened in China. And obviously, that has a large bearing on sectors like telecom, for example, or e-commerce, which are the new age tech sectors. Third has been obviously superior profitability. So as we trend towards normalization of ROE, and as we move towards a higher ROE profile, that helps as the earnings growth plays out, that becomes a very, very supportive factor for valuation in our view. And that is what we are seeing at this point in time. Clearly, you can, sort of slice and dice emerging markets in two parts. One kind of emerging market is where, I am an emerging market investor. I would be really very, very about investing into an emerging market wherein I am carrying a currency risk today in an environment like today, because we are in a very, very volatile emerging market environment, in the sense that, we have seen a dollar strength versus euro, we have seen a dollar strength versus yen. So if you are, let's say, you are investing into Russia or Turkey, which are very, very volatile currency environments, I would be very, very wary about these markets. Now, as a global emerging market investor, what are the real choices that I have in terms of, being very constructive on a market? India gives you an opportunity to invest at a very, very large size, because it is like a $3 trillion market capitalization country that we are talking about now. On top of that, we have a stable policy environment, stable policy regime, earnings growth cycle is in your favor. So in our view, and this is a view which has been echoed by a lot of people, emerging market gurus, our view is that, MSCI weight in India emerging market structurally has to move up higher from 14, 15 odd percent. So there is some room for that weight to expand as, India becomes more investable. In a market like China, for example, you are running a very, very large regulation risk. So China is a different story from an emerging market standpoint, but which is a market that gives you, currency stability and large opportunity in terms of deployment of capital. So India clearly stands out. So this premium, in all likelihood, should hold, basically, in our view. And obviously, it is corporate earnings cycle is supportive of this premium at this juncture.
Right. And with all of this said and done, clearly, if you see in terms of the kind of corrections that we've seen since the latest highs that we saw in the month of January, as well as the corresponding highs that we saw on the Sensex in the month of October 2021 as well, we've seen a correction of almost around, say, 15 to 20% on an average across, right? So do you think now is the right time to invest, or do you think it's the time to stay on the sidelines?
So it is a tale of two halves again. In certain sectors of the economy today, it seems like, you are at a 12,000 Nifty level, right? So it would be absolutely incorrect to just look at index level corrections and, to reach a conclusion. We did some analysis and we recently found out is that, close to out of 3,500 investable traded stocks, which are regularly traded, close to 850 odd stocks have corrected by more than 50%. Now, a 30% plus correction has happened in close to 3,400 odd stocks from the peak prices, right? So that is one data point. The second data point here is that, if you look at long-term average and we look at, prices to book, because, that is a matrix that we prefer at InCred quite favorably. We are at a 10% premium to historical average at this point in time. The same is true of a P multiple. So the P multiple has already contracted from 24 times on FY24. Now the question here is that, whether earnings growth assumptions will hold or not. And we are in the phase wherein, earnings growth assumption, which is the consensus earnings, was being forecasted at 15% CAGR. By experience, we know that, that consensus number has got, some sort of a downside. But the key point here is that, we are in a 10% long-term average range as far as PE multiple is concerned. And earnings growth is going to be, definitely in the range of, closer to 12 odd percent on a 2-year basis. So we would say that, today you are seeing a lot of opportunities across, various companies. In fact, just to extend that argument, the way our strategy is structured is that, we are getting today companies which are two kind of companies. One kind of companies, you have got point to point zero return for 5 years in lot many companies, and clearly I'm talking about great companies here which have been consistent market share leaders over a period of time. And then you have a second bucket wherein, you have seen a 50 to 70% correction in some of the sectors, and market has been clearly very, very harsh on those sectors, especially in B2B businesses, wherein, this inflation narrative has translated into a lot of earnings cut in certain businesses. So we have got clearly a lot of opportunities on a bottom-up basis, wherein, we find to improvise at this point in time.
Right. So, taking into consideration even in terms of the fund portfolio that you have, which is the multi-cap portfolio fund, if you could just help us understand, what is it that the strategy should be basis the fund as well, and what is the fund focusing on right now?
Sure. So we have, in terms of our investment philosophy, it is what we say is that, three things matter in investing, essentially, if you think about it. One is buying. Buying decisions are typically overemphasized. In terms of our framework, how we think about buying is that, we will focus on buying great businesses at fair value. We would like to buy good businesses at a discount. That is, and another part of our buying principle is that, obviously we would like to avoid investing into bad businesses, because what I clearly believe as a manager is that, the lesser errors we make as a part of investment process, the more it helps us to, have superior performance versus peers. So error minimization is a huge focus area for us. Sizing is very, very critical. And how much do you buy when you buy? That is what I mean by sizing. What I've experienced is that, maximum alpha is gained or lost if you don't have sizing to back you up. And the third decision at some point in time also becomes, that you have to get out of a stock, and hence, selling becomes very, very important. So as opposed to only focusing on buying, we focus on, sizing and selling as well. In terms of themes, or the way we are structured is that, we are more constructive on small and mid caps at this point in time. The reason being very, very simple. In an environment wherein earnings growth plays out, the small and mid cap companies, hopefully, that we are investing into would have a very good earnings growth profile. At the same time, we don't want to compromise on factors like leverage in the portfolio. At a portfolio level, X of financials, we are net cash. And these would be companies which are typically leaders and challengers, even though the industries could be small. So we would focus on leaders and challengers as a part of our portfolio construct. And by focusing on leaders and challengers, the advantage that we have is that, we are essentially buying into a profit pool versus buying into a revenue pool. So a lot of our companies would have a dominant revenue pool market share positioning, but they would also have a dominant profit pool positioning as well. So that is what our focus area is in terms of companies. We would focus on certain themes that we structurally like, and over a period of time, we have avoided investing into cyclical sectors, but we do invest into sectors wherein we believe that India has a structural advantage, which is on the cyclical side, which is auto anchs, which is absolutely looking very, very favorable, because it is a raw material consumer versus, so it should benefit logically. We see a significant pent-up demand. Semiconductor shortage is going to be behind us. Financials are looking very, very interesting, simply driven by the fact that, we have seen credit growth environment, which was very, very tepid. 4-decade low bank credit growth environment, which was as low as 3%. Obviously, bit of inflation helps the credit growth. We are the worst of NPA cycle is behind us. We have seen, record low credit cost for a lot of banks. So that environment is looking, certainly looking constructive. And now our post-correction IT multiples are also looking, much more reasonable. On the structural side, healthcare and IT and consumption are three sectors that, from a 3, 5, 10-year basis, one should be invested in. The only challenge here is with the consumer staple companies, wherein multiples have stayed, elevated for quite some time. So ideally, we would like to invest into companies which are much more reasonably valued within consumer staples, because we are more of a growth at a reasonable price / value sort of investors, rather than investing at growth at any price. So various set of opportunities across these various spectrums that we have in terms of portfolio positioning. Slightly overweight on small and mid caps post the correction. I think so. The environment is getting very, very constructive, because we can find companies which have declined by 50-70%. Markets have been very, very harsh on certain names, wherein our core belief at this point in time is that, the businesses are doing okay, market is not doing okay. So there are times wherein, businesses, this happens to be one of those times wherein, if you go and speak to companies, what we realize is that, business is doing okay, markets are not doing okay. This seems to be one of those times. So I think
just to interrupt over here, Aditya, overall, if you have to break it up in terms of sectors as well, I understand from a strategy perspective, for the fund as well, we are looking at buying businesses at reasonable valuations, right? Focus on good companies, focus on high quality companies. They could be market leaders, or they, with a good market share. And these are the ones, and especially the ones which have seen a correction amongst these companies as well, which would be great opportunities to buy right now. If we have to quickly divide it among sectors as well, let's look at pharmaceuticals and IT as well. What's the outlook on that front? Because again, a lot of export dependency that comes in terms of pharmaceuticals and IT. How would you view that side of it from a portfolio perspective?
Sure. So clearly on healthcare, we are very extremely, constructive. Within healthcare, there are two pockets that we prefer. One pocket being the domestic generic branded companies, wherein we see a lot of value. They are businesses which are typically, more akin to FMCG sort of business models, wherein, these companies actually own brands. The second healthcare bucket that we are very constructive on is API. We believe that API is a similar opportunity to what has happened to chemicals in the past. Clearly, valuations are very, very undemanding at this point in time in a lot of API companies, because essentially they have borne the brunt of being a B2B business. So these are the two subsectors that we really like within pharmaceuticals. On the IT side, obviously IT is a structural story. The TCVs have been, trending up well. The challenging aspect had been valuations here, because, clearly if somebody has tracked the sector over a long period of time, the kind of valuations that we had seen, especially for IT mid-cap companies, wherein companies were trading at 50 to 70 times or even 100 times, trailing multiples. One would have not imagined these kind of multiples getting attracted for a mid-cap IT company. So our view clearly is that, after correction, which is again to the tune of 30 to 50% on a lot of these IT names, IT has become a very, very interesting sector because, clearly, if you look at it, demand will hold on. India is a structural market share gainer, incidentally, in both the sectors that we are talking about. Pharmaceutical, obviously, we are a structural market share gainer. The next leg of growth is going to come from, obviously, innovation on that side. On the IT side also, there was a huge question mark that, whether India would be in a position to up its game and move from the software industry would move from a coding sort of a skill set to digital. That is what, we have clearly demonstrated. Now valuations, so one is an example of a very, very cheap sector at this point in time, which is healthcare, and software valuations have corrected. So post the correction, both these sectors are looking very, very constructive. We are overweight on both these sectors as we speak, and obviously on the cyclical bit, we are more overweight on autos as well as financials.
Right. And overall, if you see in terms of investing in emerging markets, what's your view, especially on the currency front, on the geopolitical stability front, and basis that, any sectors that you would want to recommend or say avoid?
Yeah, so essentially, on the emerging market side, the first thing that comes to mind is obviously, how stable the currency is going to be. Because anybody who is investing or taking a long-term view on India as a market has to take a view on rupee as a currency versus the US dollar. So we are in a environment wherein, broadly that 3 to 4% devaluation was given for, a 5-year, 10-year, 30-year, 40-year period. We were in a very, very stable currency environment wherein, rupee was actually in a very, very tight range from 72 to, let's say, 76 for a 3-year period. It has not happened too many times, but, that was also a time wherein we were in a slight modest current account surplus environment. So I think so. The key here is with the crude prices. If one forms a view that crude can quickly correct to something like $70-80 range, I think so India is going to be a much more constructive market to invest into. So that is something that we have to bear in the mind. Secondly, our view is that the environment of this $40 billion worth of selling, wherein FIIs have come and sold in the market, this has to reverse at some point in time, because of the various factors that I just mentioned. So our view is that, one would like to be positioned for that reversal. For example, if you look at the HDFC Bank ADR premium, it used to be 40%. It used to be 37% at the peak, which had collapsed to zero at this point in time. So that itself tells you, where we are in the cycle. I think so. These pointers are pointing that, it could be a very, very constructive market. So we are more focused on buying into large or mid-cap companies, wherein these are well-managed businesses, proven track records, but more importantly, whether they can benefit from foreign institutional ownership returning to the market. So that is how essentially we are trying to, position ourselves in today's environment.
Right. And that's an interesting strategy as well that I'm looking at. And clearly, if you see in terms of the InCred PMS multi-cap portfolio as well, clear focus, comes in from what you're saying is in terms of finding great businesses, great opportunities, again, with market leaders, and use the down cycles to, and the companies who are using these down cycles to transform themselves and are available at a cheaper valuation at the current point in time, or probably a reasonable valuations, if I may rephrase that, because of the kind of discounts that are available in few of the sectors right now. Thank you, Aditya, so much for joining us on the show. Always a pleasure to speak to you. Thank you. Stay safe and speak to you soon again.
Thanks a lot, Hiral. Thanks for your time.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.